Hey, good morning, everybody. Happy Monday. Here we are, Monday, September 9th. Wow. I'm coming to you from beautiful Carlsbad, San Diego. And today on my Facebook Live, I thought that I would cover an article that was published in the Wall Street Journal over the weekend titled The State of America's Wallet. And you know it's a good article if you can see I have nearly every other sentence highlighted. It was just a really interesting basic information article. I found it pretty interesting. I posted a link to it in my show notes here, and I also have a post on LinkedIn summarizing the key points and providing a link. Depending on how many articles you've accessed with the Wall Street Journal, you may or may not have access to this article through their paywall. But in my LinkedIn post, I gave you plenty of the key points, and so you can check out my LinkedIn post. But here are some of the key points on the state of America's wallet. I found it really interesting. In general, people have more money in the bank now than they did in 2019, and they have slightly less credit card debt, and they have slightly more income. So the key indicators are super positive. Let's get into some of the numbers. Let's go in 401ks. In 2019, people averaged $127,000 in their 401k. Today, conversely, they average $127,000. So 127 versus 104. And the reason why the author is using 2019 as a comparison point, because it's pre-pandemic and pre-crazy inflation. So it's the last static year. And so it's a really good year to compare to. So people have more money in their 401k. The other thing is people now make more money. On average, people make 3.5% earn more, 3.5% more when adjusted for inflation. So after taking into account inflation, people are earning more money than they did in 2019, with, by the way, the highest income gains coming from the bottom 25% of workers. Bottom 25% of workers have seen their wages increase dramatically, while the top end earners haven't seen the same thing. So really, really interesting. Now, this is not significant, but I still found it interesting. In 2019, on average, we carried around $60 in our wallet. Today, we carry around $74 in our wallet. So the average person, if you're curious, you want to make a bet in the bar, the average person in America walks around $74 cash. That's up from 60. I thought that was kind of interesting. They have more cash in the bank. They have slightly more cash in the bank. Now, on average, the top 25% of savers average $8,143 in the bank. The bottom 25% of savers average $1,160. So that's from February. Interesting, right? Now the saving rate is down from the peak of the pandemic when the government was flooding its citizens with money, but it's still higher than 2019. And you know what? People, though, the reason why people are keeping less money in the bank today versus during the height of the pandemic is because they have more confidence in their financial situation. They have more confidence in the future, so they don't need to keep as much money in the bank as insurance. So less money in the bank right now is actually seen as a positive sign, contrary to what you might believe. Now, the other thing you hear is, gosh, credit card debt's going going crazy. It's up over $1.1 trillion. That's the most ever. Well, that's true, but that's a false signal. It's higher than ever because there's more people here than ever. That's why it's higher than ever. It's been above $1 trillion before, but it's higher, and you also have to think things are more expensive. So debts, to buy something costs twice as much, and so you put twice as much on your credit card. So the total balances on credit cards are up slightly, and interestingly, the number of credit cards in circulation is up by about 40 million cards since 2019. The numbers are, there's something like, I'm going to go off the top of my head, there's something like 580 million cards in circulation right now, which is up 590 million cards, which is up by 40 million cards. But the average balances are actually if you compare credit card debt to personal income, it's down. It's down. If you compare credit card debt to GDP, it's down. It's less than before. It's contrary to what you say, it's not higher. And by the way, more people than ever are paying off their balances every month. Credit card usage is actually very responsible in the United States. Now, I understand debt is growing, credit card debt, which some people see as a leading indicator of a weakening economy, maybe. Cash savings balances are dropping. Some people say that's a leading indicator of a weak economy. Maybe. This article and others argue, look, savings are dropping because people are confident about their future. They don't even have as much money in the bank as insurance, would they argue. And credit card debt usage isn't out of control. It's not irrational. It's okay, right? And so interesting on credit cards and credit card debt. The average I think the average credit card debt, I'm going off the top of my head, I think it's the average credit card balance is only on something like $384. It's really minimal. It's $347. So $347. So there you go on credit cards. Contrary to the sky is falling, I don't think credit card debt is as big of a concern as we think. I think it's actually, people are quite more responsible with it today than ever. That's not to say that it couldn't accelerate. Now, if we're starting to talk about the one thing, all those are good indicators so far. Some of the negatives, as you look at people's wealth, the cost of buying a car has dramatically increased, and the cost of a car loan has increased. The average interest rate on a car loan last quarter was 7.1% versus 5.4% in 2019. Now, this is offset because the cost of an average gallon of gas is way down from 2019. So the total cost of operating a car is relatively flat. As you would imagine, and as we know, we've heard quite a bit, car insurance is up dramatically. It is, I don't have the numbers, but it's roughly maybe 20% higher than 2019, so up significantly. The average car payment right now is around $737. Maintenance is up significantly, as we talked about. And because cars are more expensive, people are keeping them on the roads longer. The average car has been on the road 12.6 years. 12.6 years, up from 11.8. Now, if you guys remember back in the first Obama administration, he had cars for clunkers, right? Where the government would pay you to take your old cars off the road, believing that it would help inflation. I don't remember how much they paid. It was like $3,000. It wasn't insignificant. And they took a ton of cars off the road, which resulted in there being a shortage. That's right. It resulted in a shortage, and kids that were entering, their driving years could no longer find an affordable car to buy. That was the result of that. So I don't know if it worked or not. But today we're a decade past that, or 15 years past that, and now average age of cars is 12.6 years. Now, as we know, homeowners got a lot richer. And homeowners that locked in a low interest rate not only got richer, but had a very low cost of home ownership. Now, people that didn't buy a home and didn't lock in a low rate, they're seeing a surge in costs of owning a home, as we would expect, right? And so the cost of home ownership right now, it's for a recent mortgage, the average payment on a medium price home from last month was $3,000. It was actually $3,010 compared to $1,566 for that same payment in 2019. So the combination of the medium home prices going up and rates going up have resulted that in those 5 short years, the cost of buying a home the price of buying a home has doubled. That's unfortunate. Now, that's going to go down, by the way, as interest rates come back down. Those costs will refinance those folks. Those costs will drop. So it will improve. And as quite a few people say, I've heard it repeatedly, we've seen the worst 2 years in affordability, and hopefully that's getting behind us as we get to a future with better affordability. The other thing that's happened, as we know, the ancillary things of owning a home, like insurance has gone up dramatically. The median homeowners insurance policy has gone from $1,164 to $1,765. So there you go. And by the way, whenever I do a Facebook Live away from my home office space, there's always a blower involved. It's just, if you by any chance, if you followed me over time, when I go remote, somebody with a blower always walks by. Now I'm in my own house, but I'm in a different place in my office, and here we go. We got a blower. I wouldn't have guessed that in a million years, but it's just something. I'll be doing a remote in a few other places this week, especially as I go to the NAHREP convention. I'll do it from the beach, and we'll see if blowers can find me there. I'm guessing they probably can. So that is the data from this article. It's a really interesting article. It's important for real estate and loan officers to understand this, because one of the things we have to tackle is psychology. People's psychology, their security, their beliefs on risk when buying a home. Now, as you guys know, I think that the greatest challenge facing home buyers today is actual FOMO, the fear of missing out. When we talk to new home buyers, or the thing they say is, look, I think I missed my opportunity, and gosh, if I just would have bought a house 4 years ago, I'd have all this equity, or I'd have this low payment. And as you know, I think the clock starts every day on that opportunity. So we have to get past some of the psychology. We have to let people know that they're better off than ever. We have to explain it to them using data, convince them that they can make great choices that lead, great choices to help them achieve the American dream and creating wealth through real estate. That's our job. We do it by getting well informed, reading articles like this and many others. Check it out on my LinkedIn. I will see you again tomorrow with hopefully yet a different guy blowing leads behind me. Thanks so much. Have a great day. Bye.